You didn't spend your money. Not really. When you tapped your card this morning, the money didn't travel anywhere. No vault door opened. No pile of cash moved from your name to the coffee shop. Something else happened, and it decides whether your salary keeps up with prices or slowly falls behind. Here's the uncomfortable part. Most of the money you use every day is not printed by the government. It is not created by the central bank. It is created by private banks, quietly, in the background, when you swipe. This matters right now because prices are higher, debt is heavier, and central banks keep telling us they're fighting inflation. But they don't control the main money machine. They just lean on it and hope it behaves. Let me show you what actually happens in the few seconds after you tap your card. Imagine you buy a 1,000-rupee jacket. Your bank doesn't go looking for someone else's 1,000 rupees to give to the store. Instead, it opens its computer system and types a number. Your account minus 1,000. The store's account plus 1,000. That's it. No truck, no transfer of physical money. Just two numbers changing in two databases. Here's the part most people never hear. If the store's account is in a different bank, the banks later settle with each other using reserves at the central bank. But the deposit that the store now sees in its account didn't exist before the moment you paid. It was created on the spot, not by the government, by your bank. This is how almost all modern money is born, and it started with loans. Let's rewind. When you take a loan, say 500,000 rupees for a motorbike, your bank doesn't go to a vault and pull out existing money. It types 500,000 into your account. At the same time, it creates a debt on its own balance sheet that says, Ali owes us 500,000. New money enters the economy. Not printed, not minted, typed. This is called deposit creation, but nobody outside banking circles ever uses that phrase because it sounds boring. It shouldn't, because that one act changes the amount of money in the entire economy. When you pay the bike dealer, that 500,000 spreads into salaries, parts suppliers, shopkeepers. It becomes real in everyone's life until you pay the loan back. Then the process runs in reverse. Your payment doesn't go into a big money pot. It erases the deposit. Money is destroyed. So money today is not a fixed supply. It expands when banks lend and shrinks when loans are repaid. Swipe, expand, repay, contract. Now, here's where the tension begins. People think central banks print too much money and cause inflation, but central banks don't control how much banks lend. Banks do. They lend when they feel safe. They stop when they feel scared. In good times, banks are generous. Mortgages flow. Car loans explode. Credit cards multiply. Money supply quietly swells. Prices don't jump overnight. They drift. Rent edges higher, food inches up. Nobody panics until something breaks. Then banks suddenly see risk everywhere. They cut lending. Loans get harder. Money stops being created at the same speed. But debts remain, and now the same economy must repay yesterday's huge loans with today's tighter money. That's how recessions really begin, not with a crash, with hesitation. This is the part nobody likes to admit. Your swipe is not just a payment. It is a vote for the system that creates money as debt first and opportunity second. There's an irony here. The more confident banks feel, the more money exists. The more afraid they are, the more money disappears. So the money supply depends less on productivity or innovation and more on mood. Financial weather. Let's put numbers to it. In most countries today, physical cash is less than 10% of all money. Everything else is bank deposits created through loans. Your salary, your rent payment, your grocery bill, all built on a structure that only works if banks keep believing tomorrow will look like yesterday. Now look around. Global debt is at record highs. Interest rates rose fast. Households are stretched.
Governments are paying more just to roll over old promises. So what happens if banks decide they've had enough risk for a decade? They don't need permission. They just stop typing. No new loans, no new deposits, and suddenly the economy feels like it's running out of air. Politicians talk about stimulus, central banks announce new tools, but they're reacting to a system whose core engine is private decision-making hidden inside balance sheets. This is why your swipe matters, because it connects your daily life to a machine that was never designed to be understood by the public. We're told money is a thing. It isn't. It's a promise that exists only while everyone keeps trusting the chain. Your bank trusts you. The shop trusts the bank. The central bank trusts the banks. And you trust that tomorrow your account will still show the right number. So the next time you tap your card, don't imagine cash moving. Imagine a number being born. Ask yourself who typed it, and then ask the real question: what happens to all of us if one day they decide not to?